The Mortgage Minute today being brought to you by our friends at Geneva Financial when you're ready for that next home loan. Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Checking the markets. Dow Jones Industrial Average now down 95.5 points. The Nasdaq's down 264 points. S&P 500 is down 31 points. The 10-year Treasury up 14 basis points, and mortgage-backed securities, those are down 83 basis points. Ugh. That's very, very painful. What does that mean for you? Well, the mortgages, yesterday, OBMMI, they are the ones that we get our data from. Yesterday, mortgages locked 30-year conforming 4.866 on the 30-year conforming, 15 years 3.925, 30-year jumbos at 4.383, and the 30-year FHA loan at 4.87. And I'm going to tell you right now, with the bonds moving up 83 basis points today, that number is going to be higher by a lot tomorrow. Why? Why is this happening to us? Well, we got a Fed speakers out there on the trail today. And when they go out there and speak, you got to be careful because it does move the markets. So we've got Fed Governor Lael Brainerd and New York Fed President John Williams, both voting members of the Federal Reserve. So Ms. Brainerd came out and said she wants to see the Federal Reserve reduce their balance sheet. What does that mean? Well, she doesn't want the Federal Reserve buying the bonds anymore. If they're not buying bonds, there is less demand. When there's less demand, and the supply is still there, the prices of the bond will drop, which, as I just shared with you, they have dropped now 86 basis points. That's almost 1% drop in the bond. That generally will equate to about 0.25% in the interest rates themselves. So bond goes down mathematically. That means rates go up. That's the way it works. Now, let's take a look further. CoreLogic released their home price index report showing that home prices rose by 2.2% in February and 20% on a year-over-year basis, which is an acceleration from the 18.5% in January and the highest reading in the 45-year history of the index. CoreLogic, though, they've been missing their forecast by a large margin. Let's take a look at what CoreLogic forecasted in February. They anticipated a 0.2% reading in the month. Meanwhile, we saw 2.2%. Missed just by, about 11 times? When we look to their report from last year at this time, they forecasted the home prices would increase 3.2%. Meanwhile, they reported today that prices rose 20%. I guess you
know better than that.
I guess CoreLogic is probably not the one to get our advice from. CoreLogic forecasts that home prices will appreciate 0.6% in March and 5% in the year going forward, which is finally moving up a bit from the 3.8 in their previous reports. Now, here's the idea: if the appreciation is only 5%. If it's only 5%, that's great. Because think about this. If you go and buy a house 10% down, that means you're getting 50% return on your capital invested. Because the appreciation is not on your capital, it's on the asset in whole, on the property in whole. So if the property, if they're right, which I don't think they are, because we're already moving along higher than that, we're already targeting higher. Well, the idea there is at 5%, it's a nice return on your money. So let's just think about that part. Top areas of appreciation: Phoenix, 30%. San Diego, 25%. And you might hear Josh in the background applauding 27% appreciation right there in Las Vegas. So we got a lot of Fed presidents still to speak. Hopefully some of them will settle the market. Neil Kashkari, not a voting member, he's going to speak. Fed governor, we told you about Brainerd and John Williams, both voting members. So let's see what they have to say. That is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. Hey, do you know anybody looking to buy, sell, or refinance? If you do, can we count on you to send them our way? We can help them. Our team is standing by. Operators are standing by.